Good morning, I'm Julie Meyer and welcome back to Entrepreneur Country TV. I am the CEO of Entrepreneur Country and I'm also the CEO of VIVA Investment Partners based here in Zurich, Switzerland, and the host of Follow the Entrepreneur Investor Summit. We talk about all of our platforms and properties on Entrepreneur Country TV every Monday morning at 9 a.m. Central.
Thanks for inviting me, for having me to FTE. It's an amazing crowd and an amazing opportunity for myself to talk in front of you. So as Julie was saying, I'm Tommaso Chiorino. Tom, it's easier. I'm an entrepreneur, I'm an investor. I come from a family business and I'm, let's say, an expert of family business network. I was also the chairman of the young side at the stage of the family business network in Italy that counts the 13% of the Italian GDP. Now I'm getting older. I'm not anymore involved in the young, let's say, chapter. So what I like to do most when I have time in my spare time, let's say, is to help family businesses in the digital transformation process or path. And it's interesting because now, in the last couple of years, this happens also with, in the same moment, more or less, of the generation handover. So we see changing the generation in charge of the companies, and we see at the same time also the digital transformation path. So just a couple of things before going deeper in this. So nobody told you seriously, welcome to Italy, guys. What is Italy? Yes, this is Italy, basically, okay? But also this is Italy. And for the ladies mainly, this is Italy. But these are big brands, okay? But this, and it sucks, but this is Italy. So the 99% of the Italian GDP is made by SME. The 70% of the GDP is made by family businesses. What does it mean, family businesses? Means having 3 generations in charge of the same business, same company. So nothing against first generation, nothing against second generation, but talking figures, 70% of the Italian GDP is made by 3 generations in charge of their own companies. They became bigger and bigger, or they disappear. Why? Because they have to choose if they want to grow, and if they want to grow now, they have to be much more close to the technology. One of these is this one. The photo is real time. No, it's more or less 1912, this one. My family company was born in 1906 by my grandfather. We were 27 in our family in terms of shareholders, and in the last 30 years we just been 3, so me and my 2 cousins. So I was the 50% of the company, and I struggle a lot because I have to decide if do my own wealth of the wealth of the company. I had a very strong entrepreneur as an uncle, so the other 50% of the company, and I decided to make a step back. That it was a very hard decision. But I did it for our more than 1,000 employees and for the other generation that were involved in the company. And I think it was the right choice. Also because I was not involved on a daily basis in the business. So why try to take the place of somebody else? Another important fact that affects family business, in Italy especially, that it's not the family business in Italy are not working very well with managers. So if you are this owner of a company, doesn't mean that you are the best manager that can work over there and that can drive the company in the future. So being owner must be recognized as a job, as a real job. So you have to study to be a proper owner, informed, etc. But you have to leave the drive of the company to experience CEO. Is what we did. Now the company is growing and growing. Now we are going to, so they are going, because I left the company. They are going to Italian Stock Exchange MTA next year. It's a super profitable company with values. So values for family companies is the keyword. So the heritage that I would like to talk to you about, it's on, for the family companies, it's on these 3 words. So no debt, clear vision, and work strong. So it's something very different from the technology company that we are facing right now in the VC world or private equity, etc. So in under to 20 years, we never had any debt. The vision was the same. We just work very strong to create value, not for the owners only, but for all the stakeholders. So for all the employees, for all the companies that work with us, clients, etc. What I decided to do when I left the company and I sold was to recreate a sort of family company that it's our family office right now, but with the same value. That it's a little bit tricky because my interest it's much more involved in a technology. So talking about no debts to startups, it's not exactly the same vision, but I decided to go on this way also on my future ventures, and I rebuilt all my assets in various financial investments, real estate, and DCG. DCG is my technology company that works on artificial intelligence based on predictive analytics. We work on the field of the big data. Big data sometimes means big trouble, everybody knows. So our aim was to give an answer to our client in terms of what will happen in the future. And that's my new venture. So talking back about the values, no debt. I decided to don't go on the VC market and try to be helped from the beginning because I was not confident, honestly speaking, about my idea since I proved it. So what we did is to, easily speaking, pay for the whole R&D, and we work with our own money for 4 years, investing quite a lot, and proving our solution in 3 continents. And now I change a little bit the value from my heritage that in disruption. Disruption for me it's something very important. I would like to focus on this middle sentence, marry the old with the new. So SME with the startups. Emil and Julie just months ago talking about that. So for me, the best way to help the small technology company, let's call startup, whatever, it's not to give just money to them, pledge, stuff like that, but to help them and to be helped by them. So, for example, let's say the normal company ecosystem have daily problem like being focused on the turnover to employees, so HR staff, everything, procurement, and they are not focused on external R&D. So I see the startup ecosystem as a funnel, a source of external R&D that can help the regular business, let's say also the family companies, to grow in the future. And the startups can be helped for all the all the way possible by the companies, by the mature companies, thanks to the previous history, be coached or helped in other ways. So finance is not just a key; it's something more. Back to my company, very quick. I don't want to bore you about this. As I told you, the investment in DCG was made with this strange focus. So we work as a sort of consultancy firm, trying to understand if our model was good, testing on the market, internalization from moment one, and leveraging my personal contacts. It allows us to scale a little bit fast and to let them work our platform on these niches, so on the retail, on the public spaces, on smart city and transportation, financial institution, entertainment, and media is not. Media is fake. Media, we did anything among media, but it's blue and it's like, no, I'm joking. We have to focus more on the media side in next semester. But we work on these pillars in 3 continents. So in Europe, in Asia, and let's say continent. It's in Middle East. It's not a real continent, but is a completely another era. And we did something very cool that I show you in a minute. How it's work our platform. So we have these modules, so the identification, tracking, engagement, and pay modules. So we get sources, various sources from different possibilities. So for example, CRM, ERPs, mobile app, biometrical solution, loyalty programs, obviously POS system, and cards, credit cards. And we create a bunch of data that we are going to crunch and digest, and then we go out with our prediction. So it's an open, very open solution and platform that identify the behavior of the customers in the past, in the present, giving answer for the future. Just some cases. For the Road and Transport Authority of Dubai, we did this project that allowed us to create a model for the transportation niche. So their problem was to work on the competition with Uber and Careem, that is the local Uber, now owned by Uber itself. And our problem was to let the taxi driver make a pickup before Uber do that. So we mix all the quantitative data in terms of previous pickups, historical pickups, and other source of qualitative data like weather condition, holiday, flights, traffic information, etc. And due to that, we allow the taxi driver understanding where you have to go before a call in the next 4 minutes. It reduced the maintenance of the taxi about 35%. They are winning the competition with Uber, also because they are price effective. And our accuracy of the prediction was the 86% now is growing in among 92%. So it's a very successful case. Again, another case was on this chain. It's called Tea Live. They own 300 shop of bubble tea. It's growing. They grow like crazy. So they are going to open 500 shop in China next year. So it's something massive, and they go to have an IPO. The CEO is 30 years old. Is a genius, really. We increase the sales on monthly basis among the 30% just working on qualitative data of the customer, just reaching to touch point. So the transactions and the loyalty program that they have. Another client, again from the Middle East. Why the Middle East? Because, and not Italy, for example, because in Italy we don't have this kind of clients, so we don't have conglomerates. This client, Altair, is a family business again, but they owns and the distribution on among 1,000 brands. And they have all the chain. So they start from the hospitals, they own restaurant, they own hospitality, they have luxury car dealer, etc. So we have the possibility to follow the entire path of the their clients' behavior. And in 1 month, this was a project led by Accenture. We increased the sales of the 15% in 1 month, just using our algorithm. And this is now under discussion with them. So this is our plan. Our plan is to run in USA as soon as possible. Why? Because we have to run to Palo Alto, as Julie was saying before. No, jokes apart, we have to go and play in the real world. The real world for AI, it's America, and we would like to grow a little bit this time, not with debt, but with financial partner, because now we are ready to show that what we can do, and we did it with our own power. And that's it. So a little summary. So what we discuss about that the 2019, so the present and hopefully the future will not exist for me if the 1906 never happened. Why? Because I understood and I had the opportunity to having values that can drive for me the change of in my entire life. Then the technology is the driver of the real change. Also for the new generation that have to go inside a family company. So, which is the best way to help a son be engaged in a family business, not being the son of, not being taking the place of the CFO or purchase department, whatever. But maybe she can be the best person in charge of the technology due to the age, obviously, and due to the possibility that now we have in terms of communication externally, studying abroad, and taking this advantage inside the companies. So the technology is the driver of change, always. Doesn't mean the sides of the business. And that we have to share. We have to talk. We don't have to be shy to talk about our problems. So what I didn't like in the association and the networking business that I work a lot with. So, for example, the Family Business Network. Everybody come on stage and show muscles. Say, I'm a big 25 generation, a lot of money, but nobody told about, yes, I had a problem with a manager and I spent 2 million to let him away. Or how you did that, what you did in this case, what's your suggestion? Nobody. So just showing muscles. In my opinion, these kind of opportunity are very interesting to understanding common problem and maybe finding solution that can be common solution. And the values are the key word again. So then there is a little call to action as a selling opportunity I'm joking about. Thanks a lot.
Excellent. Tommaso, have a seat there, and let's have a couple of questions there. Just while you're taking your seat, you know, we've had so many amazing entrepreneurs on stage, and what you said at the very end about everybody showing their muscles, I'll never forget when Ed Ray, who's one of the founders of Betfair, a very successful firm, and one of our shareholders, he stood on stage and he said that at the height of 2002, at the height of the dot-com bubble and so forth, that Betfair had systematically failed to raise capital from anyone. And it went on, of course, to become very, very successful, but he had the humility to explain, well, everybody was getting funded. You know, they were incapable of doing so. So it is refreshing to be in a group of people where people can be honest about the difficulty. You have been investing in technology businesses, you're building businesses, you have a unique insight into you know, the incumbents, the family businesses. It seems that would make you quite well placed to sell into them. You kind of said, though, that about the conglomerates and so forth. So one of my mini hypotheses has been that in European venture capital, it should be more capital efficient. If you own the factory, if you own the winery, if you own whatever the existing business is, and you have already a customer base that you're transforming with enabling technologies, as opposed to more of the Silicon Valley view, which is kind of, you know, disrupt everything, start all over, throw money at it. Americans think that, you know, money, marketing, and a good lawsuit changes everything, right? So shouldn't it work better, European venture capital, because of that installed base?
Yes, probably. I don't think that America is doing wrong and Europe is doing...
just different.
No, it's completely different. But I think that a middle point between also the two economy can be reached. So, for example, I sit in a board of a huge theme park group that have more than 12 properties just in Italy. And I just entered 2 months ago. And they didn't understood one very easy things that which is their business. And I asked to the chairman, which is your business in your opinion? And he told me, having parks. Not at all. It's driving contents to people. You have 4 million customers profiled. Value 0 at the moment.
Yeah.
So they have to leverage values. Italian companies, not European, but I talk just for Italian companies, they have to understand the value inside their company just after the brick and mortar. So US
to the end consumer. Is that what you're saying? To the
end consumer, also
yeah.
B2B. It depends. But so answering to your question, yes, there is a huge opportunity for European capitals, private equities or VC. But to do that, before you have to change a little bit the mindset of the historical, let's say, entrepreneurs. That in this particular country, it's a little bit close.
Okay, all right. And does anyone have a question for Tommaso? Yes, right here we have Nicole.
Nicole.
Get a microphone Perfect.
So
Nicole?
congratulations for what you are doing. It's so inspiring and massive, really.
Thank you, thank you. I think everyone is inspiring. Everyone here is layered individuals. But I have a really a key question, because I think every entrepreneur in the room has faced the tension of funding and the fear of cash flow, and that's we live abnormal lives, Julie. But moreover, being in technology all my life, I've been fascinated and somewhat, overwhelmed at times by the notion of facing off against a VC structure and what that would mean in terms of exchanged value to me. And so, there is such a huge diversion when you look at, the growth, the depth, the expansive nature of VC structures out of the US versus anywhere else in the world. And that's both an opportunity and a threat. So clearly, with the funding paradigm morphing around following the entrepreneur and finding really good innovation, what I've certainly seen in Europe is the morphing of traditional funding structures collapsing in on themselves. So, private equity is having to shift down, all right, in the kind of funding rounds, and VCs are being squeezed up from angel syndicates. And then you've got new funding mechanisms like, tokenized fundraising platforms and, dare I say it, ICOs of 2017. What is your view in terms of the race as an entrepreneur? How do you hedge your precious time against your choices in fundraising? If you could start again, what have you learned in terms of the most efficient source to the money?
Okay, that's a very interesting question. My Dream Coinvestor, let's say, is a club deal that can give money plus experience. So what I don't find sexy, let's say, is to have a debt with a fund. So for me, and that's my problem, because for my background. So when you read articles or posts on LinkedIn that congratulations, you were funded with 60 million euros for your startups. So if you give me 60 million euro, I think that I can sleep for 2 months. So it's the worst things that can happen to a single entrepreneur. If you are talking about another scale, so where there is, for example, a spin-off of an existing company that can be funded for R&D purpose or whatever, especially in the pharma or healthcare business, that's something else. But giving just money to startups, it's like giving a Ferrari to an 18 years guy. So
nothing good is going to happen.
No, you have, figures talking, you have the 3% of success, more or less. In Europe, it's a little bit lower. 3% of success and the money back on the VC investing. And it's not interesting. I think that the VC must grow a little bit in terms of the kind of pledge that I'm going to offer. So mixing competencies and finance.
And also entrepreneurs backing entrepreneurs, which is something that we've always tried to do, is people who've kind of been through the burning building and lived to tell the tale, to go back and help the generation that are about to go into the burning building, so to speak. Now, we've got time for one more question here. So does somebody else have one more question for Tommaso? Or I certainly do, but if there's somebody from the floor that does. Tommaso, oh yes, we've got Malcolm. Malcolm Ross, there we go.
I'd like to bounce an idea off you, because you've seen through that family association or association of family businesses tens of thousands. I've seen perhaps 10. one of the things I notice is that, yeah, you've got perhaps, if you're lucky, 1 or 2 kids in the family that are absolutely right to take over the family business, but all the rest become rich kid, you know, the Ferrari type model. One of the things I've noticed, though, is that many of them would be great, but not in that family business, but in another one. And because it's the family business thing, we're losing 30, 40, 50, or perhaps sometimes 90% of those kids that could do good in another company. Do you see that? And is there a platform we can think of to actually swap them, family swapping or something?
I think that it's illegal to swap children, but we can talk about it. Now, I think that I'm totally agree. Okay, totally agree with you. There are some studies out there that say that in a third generation business, you have the 5% of possible success that fourth generation be successful. And I think that the 5% it's too much. Not because they burn stupid, okay? But because they don't have risk anything in their life. So first of all, in all the companies that I follow and try to help, I say, okay, before taking any decision, let your kids out of the company. So the worst things that you can do is drive your children inside a company where on the wall you can find his surname. Okay, so it's impossible that the other stakeholder treat him like a professional. It's impossible, psychologically impossible. So first of all, out of the company minimum 2 years. Then they have the possibility to manage their money for maybe also small time. So maybe one year, 2 years, 3 years of real startup. Doesn't care anything it's related to the core business or not of the family. And if you do that, you have, I think, more than 60% of the possibility that they don't come back to the family business. Is it natural? It's not impossible, but it's natural that being born inside a family that owns an historical business let you be the best manager for that business, because you are drugged about the values, but also the risk and the attitude of that family. So it's natural. Nobody in Italy, or just a couple of families that I know, for example, the owners of Campari.
Mm-hmm. Very important, that's what you're about to say.
Yeah, they work exactly in this way. So out of the company, being not even a chairman, being a owner.
Yeah.
Study as a owner. It's very difficult. You have to face other kind of challenges, but you make a step back from the daily basis.
Mm-hmm. Excellent. Well, I'd love to go on and on, but we have a whole day to come. You've been very insightful. Really appreciate your input, and I know the audience did as well. And please do introduce me to the family behind Campari when I get a lifetime supply there. So thank you. Really good to see you. Thank you so much, Tommaso.